So I'm here today with Avo Momdjian, second time on the show, and today we're switching up. I think last time we talked about your history in mortgage lending.
Yeah.
We talked about different products, things that you were seeing winning at the time. I mean, this was last year. You were our first community spotlight, and I got to say, you provide amazing information. So we wanted to have you back. How you doing today?
First and foremost, thank you for having me. Doing great. Weather's finally looking nicer. So we see that sunny California back. So
Yeah.
we're all getting our tan in. Um,
Absolutely. I think I got like a little bit of red coaching soccer the other day, and I was like, "Ooh, what?"
yeah.
I don't know. Tell me, interest rates. Let's do a quick check-in on the market. Seems like the Fed's not lowering interest rates, although they're supposed to report today. So by the time this video gets published, we'll be a little behind. But what's your take?
Personally, I feel like the Fed still has a long way to go. I think that for the interim, what we're seeing on the market as far as rates being in the high sixes to low 7% range is the norm until they really tackle down on this inflation, right? Until we see inflation numbers improve, um, job market's doing healthy, so that's not really helping out interest rates lowering either. So, until we see inflation data improving, we're not going to see the Fed cut rates, which is a good thing from an aspect of less competition in the
Yeah.
market, right? At least from what I see. Um, Needless to say, we do have a supply issue as you preach to all of your buyers and there is still competition, but it's far, far less than uh, what we saw when rates were in the 2% range, 3%
Yeah.
range. You know, when people were ready to sell their arm and leg to get their offer accepted, right?
Hey, you had to buy a year's worth of pizza for the seller for like just to even be considered. No,
Yeah.
I mean, I was actually. It's funny that you brought this up. I was having this conversation yesterday, and I got to say, like, that it's probably the third or fourth time this week I've heard somebody say that they were putting things on hold because of where interest rates were at, and I followed up with, look, man, I've seen this now a few times, right? Maybe not interest rates, but it's like, what I always say is it takes courage to buy a house, right? So,
Absolutely.
so when something freaks you out, you're seeing stuff in the news, you just get spooked and you have your reasons, right? But the reality is this: when interest rates go up, the buyers back down. So, I mean, this has been going on since 2022. It's now, 2 years at this. Spring of 2022. We are at what was the inflection point in 2022, just 2 years later. I was looking at housing data for LA County, and it's not 2022 trend, but it actually has the same trend as 2023. So it's not,
Right.
but they were bouncing back and forth. Rates were still rising at the time in 2023. They put a hold on that, and I think that's made the market a little better. But I don't think they're coming down. You say economic data needs to improve. One can also say economic data needs to deteriorate for the Fed to want to lower interest rates, stimulate the economy. Like the. So anyway, the I've been telling people this. Look, and it's not the date the rate. I disagree with the date the rate. All right, that's because I don't know, in your experience, how much does the rate need to adjust by in order for it to make sense to do a refinance?
So it depends on multiple different factors, right?
Yeah.
But generally speaking, I would say if it's 0.5% to, I would say 0.75%, so 0.5 to 0.75, less than what you currently
Currently
have,
have. Yeah.
that refinance makes sense.
Yeah.
Um, yeah, so that refinance would make sense. Could put a decent dent into what the monthly payment comes out to be. Um, Also, you have to take into account what the cost of the refinance is as well, right? One thing that we offer to all of our purchase clients is a free refinance where we cover all of the hard costs. So, escrow fee, title fee,
Mm.
appraisal, underwriting. The only cost that the buyer would have, or the borrower in that case would have, is taxes, insurance, or prepaid interest, prorated interest, which is a cost they would have regardless of doing the refinance or not, right? So if they have
Yeah.
taxes coming up, they
Yeah.
would have,
Yeah.
right? But that being said, what I suggest every client or every buyer looks at today is their comfortability with the monthly payment, right? Um, it's interest rates are high across the board, and if you have the intention of buying a property today, you have to be comfortable with the monthly payment. No one's saying go
Mm.
$2,000-3,000 above your budget, right? We
Hoping
can,
that the rates come down later.
yeah, be comfortable, be content with it. You don't want to live paycheck to paycheck in a sense, and being house poor, right? The term that we hear so often. Um, go in it with a clear thought process. If you're approved for 1 million, but your budget is somewhere in the realms of 800,000, and that's a cost that you're willing to take, in a sense,
Yeah.
like adjusting your expectation of the property type that you're looking for,
Yeah.
then it's still financially feasible, and still a smart decision to purchase today, right?
Yeah. No, I agree. And has to work for your budget, right? Um, so so like you're saying, don't stretch yourself expecting the rates to come down later. Plan, buy a house with the expectation that if the rates didn't change, you would still be happy with the house, right?
Exactly.
And that's what I tell people, but like right now rates are up about 0.5% since they were last month, well, now it's May, but where they were in March, they were down in the low sixes. Now they're in the high sixes. Depending on your loans, different loans, you can be up in the sevens, but nobody's really in the fives anymore. And unless
Right.
you're buying your rate down. And we talked about that a little bit, but what I've been telling people is, look, people are pumping the brakes because the rates are up. It's a perfect time to buy, because when the rates come down, prices are going up. And now you have, and don't get me wrong, I win multiple offers all the time. But here's what multiple offers also does to us in the escrow process. When we're in the transaction, between the buyer and the seller, and we're navigating the home inspections, when it's a multiple offer situation, the seller's not really inclined to give you a whole lot. They're not, you really,
Absolutely.
we do a really good job to claw back money for our clients for repairs that they would need to do after they close escrow, or to have the seller complete those repairs for them, especially if it's a big ticket item like it needs a new roof. And the buyer, our client, the buyer, is not in a position to replace the roof, or it would make the property not, it just wouldn't make sense they don't have the cash on hand after the purchase. But when you're in a multiple offer situation, likelihood of you getting the whole roof, just plummets.
It's very
Whereas
slim.
right now, rates are up, buyers are pulling back. I've noticed in the last 30 days, with rates being up, inventories increased by about 35%. I mean, things are still going, in different price points, things are still going crazy. The LA County as a whole. So it's, but it's, when other buyers are pulling back, I always tell my client that's the time to accelerate. That's the time to really go after properties. Even if rates are up, that's the time to try to make things happen. So, and that segues really well. So, what's working right now to get rates down? Like, what are you seeing to make things more favorable for the buyer with these rates being up by 7%?
So, couple of things, and to your point, it's definitely a different market. There's still competition, still multiple offer situations.
It's spring.
But exactly. But what we are seeing is the buyer trying to find a happy medium with the seller in trying to obtain a credit back when their initial offer goes out. So, for example, I have one that's in escrow right now. The client figured out, okay, the seller's price, quote unquote, what they're happy with is around 900,000. They're happy with netting whatever they would net at 900. And the cost to buy down their interest rate by about 1%. So they went from, sorry, 0.75%. They went down from 7.5 to 6.75, and it costs 2 points, right?
Mhm.
Clients putting 20% down. So what the buyer and their agent decided to do was write an offer for 914 and ask for 14K back instead. That way they can apply it towards the interest rate, buy it down as low as possible.
Yeah.
Now, I wouldn't recommend a buy down out of the buyer's pocket today.
Okay.
And the reason why is on that 14,000, had this buyer put that out of their pocket, they get about $277 in savings from that 0.75% interest rate difference. It would take them 50 months to break even on that, which is about 4 years. And I mean, a year in our industry is a really long time. 4 years, a lot can change. So
Yeah.
if they're going to refinance in that 4 year span of time, a certain portion of that 14,000 would go down the drain.
Yeah.
Right.
Well, statistically speaking, people refinance every 4 years. So
Correct.
do lenders, in a sense, have that rigged that the break-even point is typically around when you're going to refinance anyway?
Not necessarily, because like we could wake up tomorrow and we don't have that magic crystal ball to gauge when
Yeah.
the Fed's going to cut rates. And while we're talking, I just got the update that the Fed decided that rates remain unchanged.
Yeah.
So we'll see a little bit of a pricing break on interest rates over the next couple of weeks. Nothing crazy, but usually what banks do and mortgage lenders do is, in anticipation of the worst possible case scenario leading up to the Fed's meeting, they'll bump up interest rates. And then when the Fed decides, hey, rates remain unchanged, they all take a deep breath and relax a little bit. So we'll see rates trickle down slightly. But to that point, right, we don't have that magic crystal ball to gauge when rates will drop. We could wake up tomorrow and rates are lower, and that buy down now becomes essentially pointless, right? It's money down the drain. We can't get it back.
Yeah, I mean, look, hey, I bought my rate down when I bought my house. It helped get me. It brought my mortgage down by like $200, and that was the difference between having a mortgage that was in line with the rent I was just that from the house I was leaving, and being $250 more. I mean, still the pandemic. I was early in this run of selling 64 homes in an 18-month window. I didn't know the next year I was going to go sell 41 homes.
Right.
So
now that's a different circumstance though, because rates were at all-time lows as well. Different interest rate
came
environment.
Down more after they did.
Right.
Could have refinanced if I wanted to into a 1.99. Even I think it had gotten as low as I could have refinanced into a 1.75.
Right.
And I looked at it and I looked at, you know, um, what was my actual savings, what was my monthly savings. For me, I did a little bit lower down payment. So it's like, I think I was going to take a hit on the refi being above. I was basically going to be around what I was already at. And so I was like, well, that
Right.
doesn't make any sense. Which that brings me to let's talk about refinancing. So like,
Sure.
are you doing a lot of refinances these days?
So what we're finding lately is I get numerous calls about cash out refinances, whether it's
Ah,
debt consolidation, home improvement, or someone wants to buy a nice car, right?
okay.
even I've even gotten that call, but today I would say the majority of them are for debt consolidation. What we are finding is we're doing a lot more Heloans versus cash out refinances,
Okay.
um, which it's a great tool. It's a fixed loan product. You don't necessarily touch the first mortgage, so if you have that nice low interest rate, you don't have
Yeah.
to redo the entire loan, but you get a second loan on top of whatever you have, right?
Okay.
So um, we're seeing a lot of those. I'd say on our end, we're probably taking in anywhere from 20 to 25 apps per month for that.
Wow.
So yeah, it's definitely become a big bulk of our business and a big focus in our business, other than our purchase transactions.
Yeah.
Um, with it being a fixed mortgage, people are a lot more attracted to it versus the HELOC. But I can go over the difference between the two and pros and
Yeah.
cons.
So
Um,
refinance, let's just for those of you on the call who aren't, lender savvy, I guess you would say, a refinance is, let's say you own a house and you have a mortgage on it. And you do refinance if you own it free and clear too. But, essentially it's taking a mortgage against, it's a first loan. So the first lien position. Um, you're taking a mortgage against the house. And if you already have a loan on the house, let's say you own $1 million house and you owe $500,000 on it, that new loan will pay off that 500 plus whatever else you take out if you take anything out. Because you don't have to. Let's say you buy today at 6.875 and rates adjust by 0.5% again, and then um, you adjust, so you end up doing rate and term, right? You end up just no cash
correct.
out, rate and term. You essentially, the new lender will pay off your old balance and give you the new balance, like basically your balance with a new rate, the rate and term. Um, and then there's the cash out refi, which you had talked about, where the new lender will pay off the old balance plus give you cash on top of it, depending on your equity in the property and your property value and all that stuff. So that is a refinance. It's a first lien position by a lender. The second one is a HELoan, and we should actually go into the difference between a HELoan and a HELoc. I think that's actually a really good
Sure.
topic for this call. A HELoan is some would call it a second mortgage, right?
Correct.
Okay, so you're taking a second mortgage, and what would you say? So, and a HELoc is a second mortgage as well. What is the difference between a HELoc and a HELoan?
So the HELoan, the main difference between the two is the HELoan is cash in your pocket as soon as the transaction closes and interest starts accruing and your payments start right away. HELoc, on the other hand, is usually it works like a credit card in a sense. You pay what you borrow, right? So let's say you get approved for $150,000 second loan or second HELoc, and you don't borrow it for 2 years. You don't pay anything in those 2 years, right? versus the Heloan, the second that the transaction closes, the bank is going to start sending you monthly statements, and you are going to be billed every month for the loan itself. The main difference, I would say, between the two from a payment standpoint is the Heloan is typically going to be a fixed rate,
Okay.
versus the Heloc depends. It's case by case with each lender, and they all have their pros and
It's
cons as far as it's
I took a HELOC on my house to build the ADU, so it had like a fixed rate period, and then
right.
it adjusted afterwards to
Exactly.
whatever the market plus whatever the point, like what it was in the contract.
Exactly. So it's usually whatever the prime rate is plus two, and it'll adjust periodically throughout the
Oh,
entire life of the loan.
sweet.
So so yeah, I mean, it's a great tool if you plan on um, just having it, save it for a rainy day, or if you have a project in mind that you're not really sure if
Yeah,
you're going to spend 50,000 on it or 100,000 on it, and you'll only pay what you borrow, right?
yeah,
Versus Key loan is fixed, but some people like the idea of I just want a fixed payment and that's it.
yeah, yeah. So now with a HE loan, typically in what you've seen, are HE loans better interest rate than HELOCs? Especially,
They're they're usually around the same. I would say
but the
Heloan
HELOC
is
has the risk of going up, right?
correct. Heloans, I would say because not a lot of investors are providing them.
Mm.
Uh, they're usually around, I would say, a quarter to 0.5% higher than Helocs. Um,
Oh, okay.
so
To start,
on correct,
yeah,
correct. But with the Heloc, you also do run the risk of your rate potentially going up higher.
yeah.
Um, and one thing that I do want to mention is for Helocs, typically they are a little bit more difficult to qualify for. Same with Heloans on the A paper products, right? Because they are second lien position,
Mm,
right? So you have to have a lot of equity in the property.
yeah.
They usually cap themselves out at 75% loan to value. So for those of you who are still new to the home buying process, um, loan to value is essentially what your loan amount is divided by your property's value. So let's say,
Yeah.
for example, you have a first mortgage of 500,000, your second mortgage, and your property's value is 1 million. For the sake of using round numbers, your second mortgage cannot exceed 250,000.
Yeah. Okay.
Um, now, uh, the reason why they're a little bit more stringent is because of the fact that they're in second lien position. So if for whatever reason the house defaults or goes into foreclosure,
Yeah.
they're going to be getting paid last, right?
Yeah.
So they want to make sure they cross their T's and dot their I's.
Yeah.
One exciting product that I have as far as the Heloan is concerned is tailored for self-employed borrowers who don't
Oh,
show the
nice.
strongest tax returns. It's a profit and loss statement Heloan.
Oh, wow.
So we don't verify income through tax returns, W-2s, pay stubs. It's a accountant prepared profit and loss statement, and a letter stating that you've been self-employed for, let's say, 2 years, 3 years, so on and so
Yeah.
forth. And they base your income solely off of that profit and loss statement.
Ah, super cool. So it's like a bank
Yeah.
statement loan, but a HE loan.
Yeah, exactly.
And I guess I should have said this at the beginning for everybody. So I know we're talking about HE loans and HELOCs, and you probably heard about HELOCs. A lot of companies that market saying that they have a HELOC, they actually have a HE loan. What is it? What is this HE loan HELOC stand for? So it's home equity is the HE, and then for lock is home equity line of credit, and the Heloan is home equity loan. So there's the loan part is not an abbreviation. It's just home equity loan. And so the home equity loan is a second mortgage, fixed rate. You get all the money now. It's kind of like a refinance, but let's say you have a 2%. Like for me, I had a 2.375 and I still have it. Like, I didn't want to touch that. And because that would, just to grab $150,000, that would screw up my whole thing. Right. And so I did a Heloc, and don't get me wrong, like I'm paying on the Heloc, I'm paying like almost 10% interest. But if you take my 2.375 at 600 and you take my 150 at 10%, and the fact that the work that I did increased my property value up to 1.25 million, I'm in a really good equity position with the property, and I rented the whole thing out. I'm still cash flow positive. So it's like, I think you can use financing intelligently. Hold on. You can use financing intelligently to, better your position. Let's say whatever, whether through injury or through, misfortune, whatever you want to call it. You fell on hard times. You needed to pull some money out of your house in order to stay afloat. A Heloc can be a really, like you said, let's say I don't know how long this is going to go on for, but I have, my house, I have a $500,000 mortgage, but my house is worth $1.5 million. I can potentially, easily probably get that $500,000 more. I make it a Heloc because then I can just use it as I need it. And then when I'm done, I can start paying it back off.
Right.
I think one of the disadvantages with the Heloc is it's interest only for 10 years, and then it automatically moves into a 20-year Heloan, essentially, fixed,
Right.
unless you refinance your Heloc. Whereas with the Heloan, it's how many years do they typically do a Heloan for?
30 years.
30 years? Okay.
Yeah.
So Heloan typically for 30 years. And is that, so it can go, let's say I'm 10 years into a mortgage and I do a Heloan, and 20 years from now I pay off my mortgage, I could still be paying off my Heloan, right?
Correct.
Okay. Well, that's kind of cool.
Yeah.
So,
And to your point, about using financing intelligently as well, I had a client recently and I was very intrigued with it, because it's something you don't see very often. So this client is, he's a developer, so he does a lot of fix and flip projects, and
yeah.
So he has a $500,000 HELOC on his primary residence,
Okay.
and he uses that to finance the construction cost of his flip project.
Oh, wow.
So that he doesn't touch his actual capital, right? Some people like to hold on to their cash. You don't know what tomorrow brings, right? And he doesn't want to have all of his eggs in one basket, so he always uses that HELOC on his property to finance his construction projects. So it really intrigued me.
Yeah. And he's if he's only using it, so now he doesn't have to take a construction loan, right? Which is around 10, 12% anyway. Depending on your relationship with private money lenders, but you end up having to pay points every time, and the money gets released to you in stages. So, you have to show them that you've completed a certain amount of work to get the next round of funding. And so, yeah, no, I mean, definitely in that situation, that makes a lot of sense. Look, man, right. I'm in the same thing. Like, I use the money to construct an ADU in the back of my property, right? And between the front house and the back house, I'll be clearing, a little over $6,000 a month. To put that in perspective, without the equity, without paying down the equity on the HELOC, my position is $4,500. My minimum payment every month is the $3,400 on the first mortgage, and the $1,100 on the HELOC mortgage. But as soon as, now we're starting to pay it down little by little, and as I save up money, throw it at it as well. The next thing is, once I pay it down, start using that HELOC money as like because now I have cash flow positive property. Start using it to make either buy another house or make an investment purchase. Because one, between the two, between the HELOC and the first mortgage, like I'm under 50% debt loan to value ratio, so
Right.
I'm liquid there. And then on top of that, I'm also cash flow positive, so I can in 2 years from now I'll probably be more cash flow positive.
Right. And that's the goal. I mean, using the equity is there for our use, right? And it's okay to take on that additional liability as long as there's a plan set out, and like you mentioned, it's something put to good use, right? It's going to put you in a better position than you were yesterday.
So, question for you, and we'll wrap this up. Comparing a refinance to a HELOC to a Heloan, when would you use either one of them? So let's start with the refinance. When would you use the refinance?
So if I were to do a cash out refinance, in cash out specifically, or
no, just obviously refinance rate and term is just to reduce your your rate and bring your mortgage down. When would you use a cash out refi? When would you use a HELOan? When would you do a HELOC?
So cash out refi, as long as the interest rate that you're getting is the same or better, right? The reason why same or better is if you're going to
pull money out,
and your interest rate is, let's say, 4%, 3%, and rates today are around 7.25% to do a cash out refi, you're better off going with the HELOC. The blended rate would essentially be the same. But you're paying a higher interest rate on a smaller loan amount. So I would say for a cash out refinance, as long as the interest rate is the same or better, or the alternative is if your credit is not the best, right? If it's lower than what the HELOC and Heloan lenders, and this is kind of piggybacking off of the thought process of them being a little bit more strict with their guidelines, being in second lien position. They're usually looking for 700 and up as far as credit score. Not in all cases, occasionally we see credit scores around like that 680 to 690 range, but typically around 700 and up for HELOC and Heloans. If you can't qualify for that, then I would recommend the cash out refi.
Got it.
But HELOC and Heloan, the only time I would go that route is if I have a really good interest rate on my first mortgage and I know I can qualify for a second lien position.
Okay. So it sounds like refinance if your rate is similar or better, or just your situation, you can't get the cash out unless you do a refinance, right?
Right.
And then do a HELOC or a HELoan if you don't want to touch the first and you can qualify for them at a decent rate.
Correct.
Awesome. Thank you for being on the call again today.
Of course. Man. Always a pleasure. This time not face to face. It's
I know,
giving me flashbacks to 2020.
Here, and I was like over here. I'm still in the same spot, but I get it. No, I mean, what, your office is in Pasadena, right?
Yeah. So it's a bit of a drive, but
Well,
Always like
I gotta
coming
say,
down
I
there.
mean, that's one of the cool things about being a lender is you can do a loan anywhere in the state of California. I mean, I
Yeah,
could sell a house anywhere in the state of California, but like when I sell a house, I gotta drive to it, I gotta show it, I gotta,
yeah,
you know, so we just sold a house out in the desert. I mean, crushed it, to the point where I'm
nice.
like, huh, should I be doing business out in the desert?
Hey, it's definitely gonna get you going back to the intro of the call. It's that tan is gonna get a lot more.
I don't know. I used to live out there, so I don't. I could never go back. I've actually, a lot of people don't realize that I lived. So we sold the house in Cathedral City. We're closing later this month. At the
Nice.
choice of the sellers. The sellers relocating to Hawaii, but I used to live in La Quinta, which is right next door to Palm Desert. Cathedral City's right next door to Palm Desert, but on the other side of Palm Desert, and like, it's I would. I don't think I could ever go back. I mean, even in retirement, I think I'm going to Mexico.
Oh man,
All right.
yeah.
And if anybody on this call wanted to get a hold of you, wanted to discuss what a refinance, what a purchase, what kind of loan options you have available, what a second mortgage would look like, how would they get a hold of you?
They can feel free to text me or call me at 818-334-7374.
Sweet.
Always available. Try, my direct cell number, so they can feel free to reach out anytime.
Awesome. All right, Avo Momdjian with Loan Titan. Thank you for being on the call, and
Of
we'll talk to you
course.
soon.
All right, Kev. Take care.
All right, man. Bye.